My GDX target is 180. My GDXJ target is 250. My SIL, which is the large cap silver miners, is at 220, and my SILJ, which is the junior miner, silver miner, is at 90. So those are big runs, and in the silver cases, certainly juniors, it's a triple.
Wow.
So, and I think that happens this year. So it's these are
Well,
aggressive moves if they happen, and then I think along with the stock market, you've got big downside on the other side of this. So this is kind of the end of a move, not the beginning of anything.
looking at these mining stocks indices, they haven't really. Yes, they've sold off, but given like 100 and we've been over $100 oil many days throughout the course of the last 50 days or so, and even at $88 oil, I mean, the input costs you would anticipate to go up significantly for these mining stocks, but they pretty much kept pace with the price of their respective metals. They haven't really underperformed in any significant way.
Yeah,
Um,
I think the miners this time around, not only that, but in past cycles, when you've had a move like this in the metals, you saw all kinds of M&A activity, right?
mhm.
These companies always went out and tried to get bigger and buy other companies, and they thought, they almost acted like retail investors. They bought at the top. This time around, they've shown much more discipline, and they're much more focused on their operations, I think. So, you don't capture all of that spot move in silver and gold. Obviously, they have contracts that have to run over time, but they're obviously their selling prices have moved up a lot because the metals have moved up a lot, and so they've got room to absorb the increased costs from oil, et cetera.
David, let's go ahead and kick it off with some high level introspection or high level analysis on the S&P. You can see here, I mean, we're pretty much just a smidge off the highs of the S&P. Why is the S&P making new all-time high? It seems like it was pretty much done and dusted a few weeks ago at the tail end of March, but now, we had an all-time high a couple of days ago, and here we are. So
Yeah,
go ahead.
as you know, it's not surprising to me. I've been calling for this melt up, and I think we have begun that final leg of the run to a top. Um, and frankly, we had the correction because of the war, so we sold off all through March, and I think what you've seen from that bottom, basically. A few weeks ago,
Mhm.
it really is anticipating that what we did in Iran is going to run this course pretty quickly. We had a lot of bearish talk out there, less than a month ago about, actually a couple of weeks ago even, about oil going to $200, that it was going to be a disaster for the economy, that Iran was going to be a long drawn out war like Iraq, and you had everybody coming out of the woodwork talking bearish, and the market, in its typical wisdom, looked ahead and said, "No, that's not the case." And we have seen since then, oil has come down. Topped out at 120 or thereabouts on WTI. It's come down. And I think it's going to come down a lot more once we get this thing resolved. Not, yeah, I've been pretty consistent saying I don't. My forecast, this bullish forecast, was not based on expectations of big QE. In fact, I've said part of the reason we'll have a bust is because they'll be slow to introduce QE again,
Mm.
or slow to get to a right size policy because of what they did in 2008, 9, and 2020. And Powell's been consistently saying we aren't going back there. I think Kevin Warsh has been consistent in saying he wants to shrink the balance sheet, not grow it. So that may be their intention or their desire, but ultimately, when the bust hits, there's only one thing they can do, and that is print money like there's no tomorrow. So it will come, but it'll come late, and that's why you'll have a bust. Is because almost because of what happened before, they're fighting the last war. They're reacting to what they realized was a mistake last time and saying we don't want to make that same mistake. And this time around, they're going to need to.
Does that imply that the capital or their liquidity, if it doesn't come from the QE or the money printing, then it must come from, I guess, outside the United States, from foreign investments? Or like, where do you see the liquidity come from?
No, that's why I talk about a wall of worry. You've got a lot of really since 2000, since 2022, since the bottom in 2022, institutional investors have fought this market all the way up. So they've been defensively positioned. Doesn't mean they have a lot of cash, because a lot of them can't carry cash, but they're going to get more aggressive. I think they almost, if you go back to when we were at 7,000 before the war, they were just beginning to come around to, for the first time in 3 years, they were beginning to believe we were in a bull market. For a long time, they were saying, yeah, it's going up, but it's a chance to sell. This market, they were skeptical of how far it had to go because valuations were high. When we went over 7,000 first time, was the first time you really saw institutions talking more bullish, raising targets. And then the war hit and they went right back into their bearish mode. So I think that wall of worry, even though it's bounced here, the sentiment has gone up, there's still a wall of worry out there in terms of real underlying skepticism towards this. And it's that move from that skepticism towards, wow, this thing has legs and it can go on for a couple of years, that's going to be that final move into the top, I think. And so there's cash. People seem to think markets move up when the Fed eases and that they don't move. I've been in this business going back to 1973. Back then, it wasn't. Markets didn't depend on the Fed. Nobody was saying, "Oh, the Fed. If the Fed's not easing, markets going down." That kind of mindset, I think, got built in, particularly since 2008, because that's what really drove us out of, the 2009 bottom, and then you had QE1, QE2, QE3. So people started thinking that, equating that's what you need to have an up market. Now, a lot of times it's basically organic. It's coming out of the institutions getting more aggressive, and retail, but retail's already been pretty bullish through this. So
interesting. What's the latest? So you gave us a timeline for your gold and silver price targets, but what about the timeline for the global bust? What's the latest on that? When do you anticipate us kind of running out of juice with this bull off top?
I think, I've been guilty of having to extend it. The cycle just keeps getting extended, so it could again. But my best guess right now is that it could start before the end of this year. Again, recession comes first. You don't go right into a bust. I think initially it'll be a slowing economy into a recession. But you could, if things start happening, if something triggers it, it's a possibility it could start before the end of this year, probably late this year. May not, maybe next year. And then I think most of 2027 is a global bust, or all of 2027. So whether it starts fourth quarter or first quarter next year, I think that's kind of the time horizon for when it comes. It's possible it gets delayed further, but like I said, the oil thing maybe creates more fragility. There's certainly a lot of problems. Our housing is probably going to get a bounce if rates come down here, but housing's already really rolling over. Certainly in Florida, Georgia, Dallas area. So I think we're already seeing the signs of a rolling over economy, and then you add to that the massive leverage in the system, and you can go from things seemingly okay to disaster pretty fast when things start rolling over.
Kevin Warsh, who is the supposed next in line to replace Jerome Powell here in a bit, he's a former Fed governor, and at the time of this recording, he is in his Senate Banking Committee confirmation hearing. And so I haven't had time to actually listen in on everything that's that he's been questioned on so far, because it's ongoing right now. It's ongoing live. But what do you anticipate? Do you anticipate any big policy changes from Kevin Warsh, based on what we know about him, or how do you expect the Fed under Kevin Warsh to differ from Jerome Powell, if it will differ at all?
Yeah, interestingly, yeah, I mean, I saw a little bit of the hearing, and for sure, he's getting hit from the left, from the Democrats. And we knew that was going to happen. That's typically what happens in a confirmation hearing anyway. So, but he's as qualified a candidate for this position as we've ever had. As you say, he's been a former Fed governor. He's steeped in monetary economics, more so than I think almost any Fed chairman going back all the way. And so, I think he's a great pick. Interestingly, because everybody thinks Trump wants lower rates, and interestingly, he's somebody that understands monetary economics like I understand it, which is, you don't lower rates by, it's not the Fed that cutting rates that lowers rates. It's controlling inflation, and inflation's a monetary thing. He's basically a Friedmanite. Inflation ultimately is comes about because of overly printing money or expanding the money supply. So he's talked about wanting to shrink the balance sheet back. That we went from, as I say often, in October 2008, the Fed balance sheet was 875 billion going into the crisis. It expanded from there to over 3 trillion, and then up to 3.7 trillion, I think, going into the 2020 crisis, and then went from 3.7 up to 9 trillion in response to the 2020 crisis. So we've gone from 875 billion back in 2008 to 9 trillion, and now we've brought it back down to, I think, 6.5 trillion. He's somebody that looks at that and says we're way out of bounds. It needs to get brought back down. I would argue I agree with that ultimately from a long-term theoretical standpoint. The problem is, if we're heading for a global bust, no matter what he thinks, and even if it were Powell in there, whoever is in that seat isn't going to have a choice. Like I said, they're going to be slow to, and it probably wouldn't have been much different whether it was Powell or Warsh. They're going to be slow to want to print money. They're going to be slow to react to an economy that's demanding more liquidity. They'll do it in fits and starts. I'm not saying they won't expand money supply at all. But what I think it's going to take, if I'm right about a global bust, and this is global, it's not just the U.S., I think you could see 20 trillion expansion in the Fed. So if the Fed got up to 9 trillion, you might see it get up to 30 trillion in terms of their balance sheet. If you told him that today, he'd say that's impossible. We'll never do that. I would never allow that. That's easy to say until you have a free falling financial system. And that's what I think the global bust will be. More so from, probably Europe. I think European banks are in more trouble than we are. Canadian banks are more leveraged than we are now. They were in great shape in 2008. They're now in much worse shape than we are. Our banks were forced to get religion, to deleverage, to build capital. So our banks in 2008 were a disaster. They're not today. However, banks around the globe, Europe, Asia, Japan, Canada, if they start running into big trouble, if we see financial failures overseas, our banking system's not going to skate through that. We'll be in trouble too. So, it's a small world. So if that happens, you're going to see every policymaker around the world, every central banker around the world, at some point finally recognize we only have one solution that can move fast enough to save the system. And that's when you'll see all that money. But that will come well into the downturn, many months into it. Initially, they'll be doing pieces of things. They might print $1 trillion here or $1 trillion there. But ultimately, when they see that this thing is just, I mean, 2020 was a good example. When things are really starting to unwind quickly, you can't go to Congress and say, can you come up with a solution? Can you figure out fiscally what we can, it'll take months for them to figure out what to do, even if they move fast. The only thing that you can do that is quick is money. And it will take all kinds of liquidity poured into the system to stabilize the system and begin to move it the other way. So that's, frankly, as much as I think Warsh is the best person for the job, ultimately, I think the macro trumps, no pun intended, but the macro trumps any policy. It doesn't matter who it is, they're going to be forced into this, both here and in the central banks abroad. Yeah, just because of where we are in the cycle, I just want to kind of make a little bit of comment about, if I'm right, and again, that's still an if, but if I'm right that this is a blow off top, that we're going to see, potentially 35 or 40% move here in a very short period of time, 4 or 5 months, I would just caution people to understand who you are as an investor, as a trader, whatever you are, understand how psychology works, and just be aware that as we get closer to that top, if we see that kind of a move in a short time, the way psychology works is you're going to be more bullish, not more bearish, most people at the top. And there's going to be a compelling reason. You don't go to a top with everybody thinking negatively. You're going to be at that time hearing all kinds of narratives that will convince a lot of people that this thing has legs. It can go on for a year or 2 or 3 more, that the Fed's behind us, the wind's at our back, that, the situation in the Middle East is resolved. We have peace breaking out around the world. There's going to be a bullish narrative out there. I can guarantee that. And what you have to guard against is getting caught up in that. And people need to understand how sentiment works and how markets work, so that at the very top of a market, it's hard to sell. It's hard. You're looking and you're saying, well, what if they're right? Look what I could miss. And I would just caution people: don't be greedy. If you're in and you've ridden it, understand that as it's thing, and it doesn't mean the minute you hear bullish sentiment is up, like we saw on that chart. It over time, people keep asking me, how will I know when the top is in? And I say, I obviously won't be able to call the exact top. Hopefully, I can get close, but I may not. But my signal will be when everybody else is all in. When you're hearing everybody tell you that this thing has legs and that they're in with both feet, that's a signal to say, hey, I may not be capturing the top, but I think I've captured a good part of it. So I would just tell people as a contrarian, it's important to understand how markets work and how sentiment works with those markets.